In today's video, we're covering everything that you need to know about incentive stock options, ISOs. Now, a disclaimer, as always, we created this video to provide a general overview of tax and financial topics. It's always important to reach out to a tax professional about matters specific to your situation. All right, so what are stock options? Stock options are a form of compensation that gives an employee the right to buy shares of company stock for a set price at a future date. Stock options are usually issued by private companies that plan to go public at a future date, and therefore act as an incentive to remain with the company long term due to vesting requirements and the potential that the company goes public. They're usually awarded as part of an employee's hiring or promotion package. Employer-granted stock options can be incentive stock options, ISOs, or non-qualified stock options, NSOs, and their tax treatment does vary. Now in this video, we'll focus just on ISOs, incentive stock options, and we'll always refer to that as ISOs, so I don't have to say it every time. Now, stock options typically have a vesting schedule that must be satisfied before the employee can exercise their options. In other words, you must stay at the company for a certain period of time before you even have the right to exercise or own these options. Now, many companies use what's called a 1-year cliff schedule with a 4-year fully vesting period. This is pretty common. This means that you vest 25% of your options granted to you after 1 year with the company, and then the remaining 75% vest over the subsequent 3 years. So after 4 years, the employee would be fully vested on the original grant at least, and have the right to exercise 100% of their stock options. YouTube is a great place to learn all the financial 101 lingo that we never learned in high school and college. I'm here to teach that. Hit subscribe and follow along. Now let's go through some key terms for ISOs. First, on the schedule. ISOs are issued on a beginning date, known as the grant date, and then the employee can exercise their right to buy the options on the exercise date. Once the options are exercised, the employee owns the company stock. It's no longer an option, just like you would if you bought an individual stock of any company. The employee then has the freedom to do whatever they want with the stock. They can either sell it or hang on to it. You own it. For example, an employer may grant you 1,000 shares on the grant date, with 250 shares vesting 1 year later. That means you have the right to exercise 250 of the 1,000 shares initially granted after year 1. The year after, another 250 shares are vested, and so on. Depends on the company. Now, vesting. ISOs usually contain a vesting schedule that must be satisfied before the employee can exercise the options. Now, the vesting date is the date when the employee is eligible to exercise a specific number of options. You don't have to exercise, but you're eligible. A 1-year cliff schedule is common, where the employee becomes vested in 1/4 options issued to them, and then the remaining options vest over a remaining period, typically 3 years. Vesting simply means you have contractually fulfilled a specified term of employment with that company, and then you have the option to exercise the options. Now, exercise. To exercise an ISO means you purchase the stock at the predetermined price upon granting. The price at which the employee can purchase shares is known as that exercise price. In most cases, it's simply the stock's market value on the grant date. If the stock price goes up by the time you vest, which you hope it does, your option is considered in the money, meaning you can buy the shares at a lower price than what they're now worth. The difference between the exercise price and the market value at the time of exercise is referred to as the bargain element if you're in the money. This is why it's important to consider the company valuation at the time that you might join a company. You want to have the option to exercise that stock at a lower price than what it's worth in the future. Expiration date. This is the date after which the employee can no longer exercise options. So watch out for this one. And in most cases, the expiration date is 10 years from the grant date or 90 days from when you leave the company, whichever is sooner. Many employees forget about this expiration date, so it's super important to remember this schedule and act on it, especially if you're leaving a company. Okay, so how are incentive stock options taxed? ISOs are typically only taxed when you sell the stock after exercising. For normal tax purposes, keyword normal, exercising your options is not a taxable event. You just want to be aware of the alternative minimum tax, the AMT, which we'll cover in a bit. ISOs are only taxed when you sell your stock post-exercise. The time frame since your grant date and exercise date will determine your taxes here. So if you sell the stock less than 2 years after the grant date and 1 year after the exercise date, This is considered a disqualifying disposition, and you're taxed on the difference between the exercise price and the sales price at the short-term capital gains rate. If you sell the shares more than 2 years after the grant date and 1 year after the exercise date, this is considered a qualifying disposition, and you will be taxed on any increase in value over the exercise price at the long-term capital gains rate. So to put this another way, you're not usually taxed upon exercise, but when you go to sell the stock, any increase in value over the exercise price will be taxed at the long-term capital gains rate as long as you meet both of the following conditions. You hold the shares for at least 2 years after they were granted to you, and then you also hold the shares for at least 1 year after exercising them. 2 years after grant date, 1 year after exercise date. If you do not meet these two conditions, you'll be taxed at the short-term capital gains rate, which is your ordinary income rate, upon the sale of your shares. This is what can make this decision so tricky. Do you exercise and then hold on until you reach that long-term capital gains rate? Or do you just exercise and sell right away and then diversify your investments while potentially taking a larger tax hit? You're certainly taking less risk in selling right away, but it doesn't always feel great to sell all your company's stock. Now, the AMT, alternative minimum tax. We mentioned earlier how you might incur taxes upon exercising. This is due to the AMT. This is a separate tax system designed to make sure high earners pay at least a minimum, hence the name, amount of taxes. If you exercise your ISOs and do not sell them that year, the difference between the exercise price and the fair market value at the time of exercise is subject to AMT, even if you didn't sell any shares. And this one gets really complicated. Whether or not you pay AMT is largely dependent on your income. In 2022, if you're a single filer making less than $75,900 or a married couple filing jointly making less than $118,100, you do not need to worry about it as you're under the AMT exemption. If you earn more than that, you'll need to calculate your taxes under both systems, AMT and the regular system, and then you pay whichever amount is bigger. The good news is that your AMT payments are credited against the taxes owed upon the sale of your stock, but you will owe taxes on the bargain element at exercise or in the year in which you exercise. Now, when should you exercise ISOs? Generally, if the strike price of your ISOs is less than the current market price of your company's shares, you'd consider exercising your options. This way, you could buy the stock at a lower strike price and in turn, sell these shares in the market to earn the bargain element right away. The difference between your strike price and the market price. This is the game. If the strike price exceeds the current market price, it likely would not make sense to exercise your ISOs because the company's shares would be cheaper on the stock market. Now, if the strike price never goes below the market price, your ISOs could expire worthless. That is a risk. If your company is privately held, you may want to consider exercising your options when your company begins the process to go public, as opposed to waiting so that you can avoid having too much money tied up in the stock without being able to sell. That's because once your company files for an IPO, you generally will not be able to sell your stock for at least 1 year, because a company's stock doesn't usually trade publicly until approximately 6 months after it starts the IPO process. And also, once a company is public, employee shares are typically restricted from being sold for the first 6 months, which is referred to as the employee lockup period. So if you wait to exercise until your company starts the IPO process, it not only gives you the most certainty that your shares will actually be worth more than your strike price, but it also may allow you to sell your options or the stock after you exercise as soon as possible, while still qualifying for the long-term capital gains tax rate. If your company is publicly traded and you have not yet exercised ISOs, the benefit is that you know what the stock price is worth at any given time. You know what your bargain element is. So if you're ready to exercise post-IPO, you can do what's called a cashless exercise, where you simultaneously exercise your options and sell the stock in the same transaction. There are a few strategies to consider, but you should check with your CPA about the specific tax implications for your equity. You can also do a same-day sale where you exercise your options and then immediately sell the underlying stock in the open market if there's a substantial spread between your exercise price and the current trading price of the stock. Now, you also could consider exercising and selling to cover, where you only sell enough shares to cover the income and payroll tax withholdings so that you're still left holding a portion of the exercise shares. The benefit to holding your exercise shares is that you can qualify for the lower long-term capital gains rate. This likely means selling about 30 to 40% of the stock after you exercise. And you can also exercise and then hold in a staggered approach. This gives you the opportunity to sell stock as you exercise additional options. This choice can be particularly beneficial if the stock has been held for over 1 year and the associated gain qualifies for favorable long-term capital gain treatment. Now, other considerations. There is a strategy with stock options that you can use to potentially minimize taxes through what's called an 83B election. This allows you to exercise your options before you're vested and then pay taxes up front on the value at the time of granting. If you anticipate the value of your shares to increase in the future, this strategy could reduce taxes down the road. Keyword could. On the flip side, if your company shares decrease in value, you've essentially overpaid taxes and you don't get anything back for that. The IRS doesn't fall for that one. Now, NSOs. Non-qualified stock options are another type of employer-granted stock option that we will not cover in depth in this video. So subscribe to our channel to get notified of when we release this one. Now, in the case of an NSO, you incur a bill right when you exercise that option. The difference between the exercise price and the fair market value of the shares is subject to ordinary income taxes in that year. For this reason, ISOs are considered to give a more favorable tax treatment in most cases. However, NSOs do not have an expiration date and you don't have to exercise all your options if you were to leave the company. Thanks so much for watching. I'm Tony from Wealthfront. Take care.